I'm here with Dion Hershan, Executive Chair and Head of Australian Equities at Yarra Capital. Dion, thanks for speaking at the Inside Network's Equities and Growth Assets Symposium.
Thanks for your time.
Now, the tagline of the event is Sailing Through the Headwinds. In your opinion, how should advisors try to achieve this?
I think the easiest way to sail through the headwinds is frankly, to avoid the most problematic parts of the market. And we think some of the more problematic parts of the market are the 20 biggest companies. The 20 biggest companies are really dominated by banks and iron ore companies, and short, medium and long term, we feel those businesses have got challenges. So the best way to sail through it is arguably to sail around it. And sailing around it, we think, is looking outside the 20. There's some brilliant small and mid-cap companies that have got uncapped growth potential. They're not levered to the domestic economy. They're actually levered to their own circumstances. And they're often very inefficiently researched, and that's why we feel they're the best opportunities.
And on your session today, you touched on some of the innovative enterprises that sit outside of the largest 7 or so listings by market cap. Which themes do these businesses tap into generally?
Look, there's a few themes we're simultaneously exploring. Obviously, there's substantial growth both locally and globally in technology companies. A lot of these companies have got great pricing power. The value and use of their products or their services is really substantial, and they're at a very early stage of their development. So tech's an obvious theme. It's been well documented by many, but we feel there's an opportunity in Australia. Second theme we're exploring really closely is which commodities look exciting because there's going to be supply shortfalls. Most of the analysis in the resources market focuses on demand and what's growing. It often ignores what's happening on the supply side. And we think with a lot of commodities, there's been chronic underinvestment, and that will play out in terms of shortfalls and significantly higher commodity prices. So that's a second theme we're focused on.
And many advisors focus on international allocations to achieve growth. What are the counter-arguments there? What can Australian equities achieve that are potentially superior?
Look, I think there's a place for both in a balanced portfolio. The obvious advantage of Australian companies, in particular if you look outside the most mature 20 biggest companies, is the businesses you've got a high degree of familiarity with. Typically, Australia's got good governance, good rule of law, really favourable industry structures. And in particular for Australian companies that can compete globally, and there's a few but not many, they've also got uncapped growth potential. So that's why we feel that there's a really strong place for both global equities but also certain domestic equities.
And for you personally, what is the most enjoyable aspect of your work in building this portfolio?
Undoubtedly, it's about discovering these businesses, learning more about the management teams, the products, the services, the culture of the companies, and really tracking their growth trajectory and, importantly, putting our clients' capital behind great ideas.
Finally, should we expect any big surprises in markets this year?
Look, by definition, you often don't see the surprises coming. The one that we are squarely focused on is everyone seems to be really confident that inflation will fall and rates will be cut. That is the consensus view. Often where you see surprises is when there are big changes. So we probably subscribe to the view that inflation is coming down. Possibly there won't be rate cuts in Australia because the environment is still solid. But the tail risk that we're really focused on is a second wave of inflation, which nobody seems to be talking about, but it's absolutely possible, in particular, if the energy sector gets tight and commodity prices surge, we could well be facing into a second wave of inflation, which would be problematic both for the economy but also for rates.
A fair warning to investors. Dion Hershan, thanks for joining us.
Thanks for your time.